Keppel Infrastructure Trust has just announced a special distribution of 2.33 cents per unit, bringing the total 9 months DPU to 5.23 cents, up a whopping 83% on a year-to-year basis. This is as a result of the 273 million gains in capital optimization from both EZOM and City Energy, and this is driven by the higher EBITDA and business growth. So 131 million is to be paid out as a special distribution to reward unit holders, whereas the balance 142 million is utilized to pay back the borrowings from financial year 2022. In fact, the share price shot up 13.6% the day after it announced such a good news. Alright, so now the question is the trust still a good buy now? Stick around to the end while I help to answer your question. Let's go through the portfolio first. For Keppel Infrastructure Trust, or KIT in short, it is the largest trust in Asia with a portfolio AUM of 7.3 billion for FY 2022. Okay, the portfolio comprises mainly of three segments: the energy transition, environmental services, and the distribution and storage. So these assets are spread out across the globe: Singapore, Australia, Philippines, and even Saudi Arabia. Some local assets we are familiar with include City Energy, Sinoco Waste to Energy Plant, and the Sing Spring Desalination Plant. Long story short, the portfolio of these evergreen assets provide the essential services we need, like water, energy, and waste treatment. So this means that KIT can actually generate stable and predictable cash flows for a long run. Previously mentioned, KIT declared a special distribution of 2.33 cents per unit. So what I want to find out is really whether the yield without the special distribution is still attractive and growing. Okay, so looking at the table here, the DPU trend is stable and growing slowly but gradually. Okay, the annualized DPU will translate into a yield of about 7.7% based on the current share price of 50 cents. Kids' net gearing stands at 36.8%, a comfortable headroom compared to their internal goal of 45%, although business trusts have no gearing restrictions. What I like most here is that KIT is over 90% insulated from the ongoing rising inflation because they are able to pass through the cost to the customers in general. All the refinancing due in 2023 is also completed, and they will fund the 2024 loans using their own cash flows. So based on my gut feel, we're going to see interest rates winding down by maybe end 2024. So kid investors won't really have to worry about the debt, since the bulk of the debt maturity is only going to happen or undergo refinancing in the year 2026-27. Before we move on to the next point, don't forget to smash the like button, subscribe to us, and ring the notification bell so you never miss an update on these investing ideas. To show my appreciation, here's a financial meme for you. Generally, I think it is safe to say that the trust will continue to make inroads into the renewable space through acquisitions in AAA rated developed markets, as shown from the track record since 2019. On top of that, we can also see organic growth from various areas, such as City Energy's expanded EV charging business, exploring a green hydrogen pipeline from Johor to Singapore, additional grid capacity in Europe, and even the increased demand for Philippine coastal tank asset. According to Y charts, the price to book ratio of KIT stands around 1.7 times, relatively unchanged in the past 10 years. And if we compare it to the other peers in the gas utility sector, The valuation trades pretty near to the industry average price to book of 1.3 times and on par with the other regional players like Hong Kong and China gas of 1.7 times and also cheaper than Petronas gas per hut with a 2.6 times price to book. To wrap up, people like the defensive assets of KIT because it can continue to churn out recurring inflation-protected cash flows, especially in this high interest rate and uncertain climate. That being said, in the past 1 to 2 years, the share price actually dropped because the gearing level was very high at 42%, and a lot of that was due to mature in 2023-24. As a result, KIT has to do a private placement to raise funds for debt and ongoing new acquisitions. And by nature, we have to understand that infrastructure assets have some kind of a contract terms or concessions with the other party, like the government. So it's not like they can own the buildings freehold and forever. So there's always the risk of the government not renewing the concessions. So there are two big ones to note in the near future: the Sinoco plant and the Sing Spring desalination plant. But anyway, overall, we still like the current situation around Keppel Infrastructure Trust. So they have evergreen assets, healthy gearing level, lots of room for growth since they are targeting to grow the portfolio to 18 billion in the next decade, and also their constant pivot to the renewables sector. So, in fact, we have added the trust in our patrons' model portfolio some time back. If you are interested to join our patron community, you can get started for free by clicking on the link below. Before we end off, if you find this video helpful for you, do remember to help me smash the like button and subscribe to my YouTube channel for more videos like this one. Do remember to help me and don't forget to check out this video over here talking about 5 Singapore stocks trading near 52 weeks low. With that, I will see you in the next one. Thanks for watching and ciao.